Good morning and welcome back, everyone, to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And we start off today's session with a pretty significant shift in terms of tone for the equity markets versus the previous 2 weeks that we've been here. Um, Starting off 2025 originally with what was meant to be quite a bit of optimism around the equity markets, we find ourselves in a position that's far more precarious. So let's take a look at kind of where we currently stand with the charts and what our outlook is going forward. Now, the S&P 500 over the past nearly 2 months or so has really effectively traded sideways. And, despite multiple attempts to kind of break out to new highs, what we have seen is really more of what looks like a bit more of a head and shoulders top rather than a continuation higher here. And I think over the last few trading sessions where we broke below the 50-day moving average and started to also start to test some major support levels around 5,800. This is really starting to put into question kind of the overall direction here for equities. Now, we opened up here yesterday just below that $5,800 level, but managed to close on the day back above that level, showing some sign of strength here that the bulls may still have enough ability to kind of maintain their view here on the control here on the markets here. Um, uh, I apologize. No. This is the significant shift that we've seen in terms of tone here for the equity markets, with the S&P 500 testing some major support levels here, especially when you look at in conjunction the other markets. If you look at the Nasdaq 100, you note that we recently just broke below the 50-day moving average here. That is certainly a bearish sign here for the equity markets. And then you combine that with the fact that the Russell 2000, over 2 weeks ago broke below the 50-day moving average, failed to kind of retest that as resistance, and also has started to kind of recently break below some support levels here on yesterday's open. This is really starting to paint a picture overall that is an equity market that is far weaker going into 2025 than what I think a lot of people were expecting here for this particular year. You have same thing for RSP, the equal weight S&P 500 index, where we broke below the 50-day moving average over 2 weeks ago, failed to kind of retest those levels and have started to break below some important support levels here as well. The question is really going forward what our view is. And if we have to look at kind of the other markets here, we notice that, value has started to outperform growth by quite a bit here over the last few trading sessions. Um, We've seen commodities have absolutely taken off here, as you can see, revisiting kind of 52-week highs here. If you look at kind of gold and silver, I'm sorry, gold and oil. And more importantly, I think one of the things that we've been paying attention to is the fact that HYG, high yield corporate bonds, have sold off here as well. We've kind of broken below that 50-day moving average. This is a sign that we're in a much more risk-off environment here in the overall markets, not only for equities, but also bonds. But there are some signs of stabilization here. You have the VIX yesterday kind of settling back down around that 19 level where it opened up here, showing that there wasn't necessarily an expansion in fear over throughout yesterday's trading session here. We obviously have the CPI and PPI print here later this week. That is going to potentially be a primary driver of sentiment here. That's really going to be one of the things that we're going to be paying attention to here for right now. But I think probably the most important metric to pay attention to right now is the 10-year yield. You have the fact that the 10-year yield is trading around 4.7%, levels that we haven't seen here over the last year or so, and really starting to potentially put 5% into target here. That's really levels that we haven't seen in 20 plus years. So we very much are heading towards a regime where interest rates are clearly going to be higher for longer than I think a lot of investors were anticipating at, even just a few months ago. Um, with the strong labor market and inflation continuing to be persistent and well, it seems like there is likely going to be some inflationary policies coming up with the latest administration coming in. This is really what's been driving yields much higher, and that's been souring the overall sentiment here for equities. And I think for a lot of traders, the question is, can yields continue to rise? And if they do, how far can they go? Because that's really going to be what's going to drive sentiment here over the next a few weeks outside of earnings season that's about to kick off here. I think that there's elevated risk here for the upcoming earnings season, given how high the bar has been set. So I think you're going to likely see some muted moves if a stock does beat on earnings, meaning stocks that beat on earnings will likely have limited upside potential here versus stocks that do miss on earnings likely will have substantial downside risks. And that skew is really, I think, one of the things that as traders we need to pay attention to going into this specific earnings season and what our expectations for big moves or where those big moves may potentially come from is more likely to come from misses than beats given kind of just how far expectations are at the moment. You see TLT, the bond ETF, kind of continuing to sell off here. There are some signs of positive divergence here, but as you can see, we're starting to get to a point where the momentum is starting to confirm these new lows. So yeah, it does very much point to a potential bottom here in TLT, right? We are basically at the 52-week low. This very well could be a level that we start to bounce from and start to recover from. That's yet to be seen, but I would say obviously a breakdown below 85 would be an extremely bearish um, would be a very bearish outlook here for both bonds as well as for equities if we do break below that $85 level here on TLT. So that's a really important one to pay attention to here going forward. Um, the US dollar continued to rise here above that 109 level here on rising yields. I expect that to continue. Gold, as you can see, is kind of continuing to hover above that 50-day moving average here around $2,700. And oil has really taken off here, settling just shy of $78, which was our upside target here for oil. And we'll see if we can push back above 78 and continue on into kind of the low 80s here to the upside for oil. That very much, I think, is the next upside target here for oil. And then looking at the overall sectors here, this is really where we've seen some level of rotation here and some flight to quality and flight to safety. So if you look at technology has gotten hit quite a bit here as a sector over the last few trading sessions. But overall, as a sector, technology is not necessarily outperforming or underperforming the S&P 500. It is effectively trading in on par with the rest of the market here right now. But we are starting to enter a period of small underperformance and potentially further underperformance here as a sector. So this is one that I think a lot of investors obviously have portfolios heavily weighted in tech that we should be aware of. Consumer discretionary is the only sector that's still holding on to the 50-day moving average here right now. This is the sector that has outperformed the S&P 500 by a very large margin here over the past few months. It's given up some of those gains here over the last couple of weeks, but very much still in the big picture, the sector that is outperforming the S&P 500, the one with the most strength here at the moment. You have communications similarly outperforming the S&P 500, giving up some of those gains here over the last couple of weeks, but largely, all in all, still one of the sectors that is one of the strongest relative to the rest of the market. But we did recently break below that 50-day moving average, which is something to be aware of going forward. If you look at other sectors here, they have either, have just started to roll over above below that 50-day moving average, like XLF has, or they've already done so, a few weeks ago. XLF, as you can see, broke down below that 50-day moving average. It's starting to roll over, starting to break below some short-term support levels here. And as a sector, this is a sector that has outperformed the S&P 500 for the last 6 months or so, but have given up a lot of those gains here over the last month. Consumer staples is one of those sectors that consistently underperforms the S&P 500 and continues to do so. Consumer staples, not giving that specific defense here in this particular market. But if you look at healthcare, a sector that has underperformed the S&P 500 by a very large margin here over the last 4 months or so, actually showing a little bit of strength here over the last couple of trading sessions. So this is the kind of the flight to safety that we've seen over the last few trading sessions. As you can see, healthcare up 1.3% here yesterday. Clearly outperforming the S&P 500 by a pretty wide margin. Interestingly enough, same thing here for materials. You have a long period of underperformance as a sector, but a small amount of outperformance here over the last couple of trading sessions. So one of the few sectors that are starting to show some strength here right now in the overall market weakness here. Industrials, a little bit here, underperforming the S&P 500, sharp outperformance here over the last few trading sessions. Real estate still continues to underperform the S&P 500. This is not surprising given kind of where yields are. Real estate certainly one of the sectors that we expect will be hit the hardest with the 5% yield environment on the 10-year yield. Energy shares breaking above the 50-day moving average here yesterday, showing some further signs of strength here. Looking for that continuation higher here into the high 90s, while utilities at the moment still continue to underperform the S&P 500. So if you take a look overall, we have a picture for equities that's continuing to deteriorate between the S&P and the Nasdaq, now below the 50-day moving average, while the other sectors, other markets and sectors have already gotten there. You have a bit of a risk-off environment here from bonds, and the biggest headwinds here is really, whether or not yields can continue to rise, and that is very much a possibility here, especially on the back of the CPI print here this Wednesday. So pay attention to that event, and that will likely provide quite a bit of insight into kind of future sentiment for the next few weeks. So with that, let's take a look at some of the ideas here for the week. These sessions, what we try to do is provide a bit of a balance between looking at the macro picture and what our views are from a technical perspective and a big picture perspective, and at the same time looking at some of the individual ideas and symbols that we have here in the overall market. So the first one I want to take a look at are some of the new trade ideas that we currently have here. Netflix is one that we've been paying attention to here. As you can see, Netflix has gotten all of the classic kind of head and shoulders patterns that you would typically see with the top here. So some level of that, and you also have a neckline here around 875 that's been broken here to the downside. This is really one that we're paying attention to for some potential downside here. Our downside target here is around $700 or so, which is also a gap here that has not been filled. That would be our initial downside target here for Netflix. Next one I want to take a look at here is Take-Two, which is gaming stock. Similar kind of price action here to Netflix, breakout above kind of a major resistance level here around 170, 172 and a half here. This resistance level has been broken out here to the upside. So far, that upside has not really been met with much momentum here. It's kind of pulling back to that 172 and a half support level here going forward. And the last one, which is another bearish trade here that we recently added, is Tesla. This is more of a fundamental play here. This is a stock that's now trading at 120 times forward earnings. Given the fact that, we just saw deliveries slip here on 2024, where we actually saw a decline in deliveries, the EV car market space is getting a lot more crowded here. Uh, there's a lot more competition here for Tesla, and the valuation hasn't been higher in a while here. So trading at 120 times forward earnings, we're really talking about a valuation that's 12 times higher than the average industry median for the car makers. So, you can talk all you want with regards to, the valuation of the robotics business, the robo-taxi business, uh, the other forms of tech that, Tesla has. Built into the outlook here for the company, whether that's AI or robotics or any of the different projects that Elon Musk is working on. And I have great respect for Elon Musk. I think he's a fantastic operator from a CEO perspective. The fact that he's able to operate so many successful companies in parallel is really quite unfathomable. And Tesla overall, I like as a company, but the one thing I cannot get myself around at the moment anymore is just the valuation that it's trading at, 120 times forward earnings. There's just too much risk here, too much downside risk, given the fact that they just missed on deliveries. And that's really where I think there's some downside risks to holding on to Tesla. Um, One stock that I really like here at the moment here is Visa. So similar to kind of the other trades, but from a valuation perspective, looks a lot more compelling. You've got the breakout here above $300 here. It's kind of traded up higher here, pulled back to that level as support, and this is really kind of where the risk to reward is extremely favorable for adding to Visa, trading at 28 times forward earnings. It is still, in my opinion, fairly inexpensive from a valuation perspective. If you look at kind of net margins on Visas approaching 55%, that's really something that's fairly unparalleled in this particular space. And the fact that they're able to generate so much profits for every $1 they generate in terms of revenue is really what justifies the relatively premium valuation that we see here for Visa going forward. Boeing is another one that I really like here at the moment. Notice that over the volatility that we've seen here in the last few trading sessions, Boeing has actually kind of traded sideways, which means that it's actually been outperforming the S&P 500 over the last couple of months. It's holding that 50-day moving average. There's some signs that, from a fundamental perspective, this is starting to look a lot more attractive. It's only trading about 1.4 times sales, which is a pretty significant discount relative to the industry median. It's expected to grow faster than the industry. The only thing it doesn't do right now is turn a profit. But if you look at kind of the new CEO, You look at how hands-on he is. You look at the fact that he recently moved out to the Seattle, to that Redmond, Seattle area where Boeing assembles their planes and have worked on both resolving kind of the labor dispute that Boeing had, has started to work on changing company culture. He's a very hands-on CEO, and I think there's going to be some dividends being paid out of that for investors who are taking on a more speculative position right now with Boeing early on. I think this can pay off to some nice gains here over the next couple of years with Boeing if they can kind of stay out of trouble with regards to the regulators and with from a quality assurance perspective, and can focus and put their heads down and focus on deliveries and improving kind of the number of planes they deliver from a monthly basis on both 737, 787 programs, as well as the 777 program. Those are all critical here to the success here for Boeing. Um, Another one that I want to take a look at here is NVIDIA. NVIDIA, I still think at the moment is still one of the cheapest stocks here on the market, trading at about 30 times forward earnings, 29 times forward earnings. If you look at kind of the expected growth rates and how profitable NVIDIA is, the fact that it only trades at about 29 times forward earnings is just downright inexpensive. So we know that a lot of tech companies still have very strong anticipate that 2025 will still be a strong year in terms of build outs here for data centers. NVIDIA is obviously at the forefront of that specific data center build out, and we expect that sales will likely continue on the current trajectory. And this is the stock that's trading at a very steep discount if you consider the growth and profitability of the stock itself. Another tech company that I really like here at the moment here is Meta. Meta now trades at about 24 times forward earnings, so even more inexpensive. It is also expected to grow at a very healthy clip here relative to the S&P 500. It is far more profitable than the average tech company with net margins around 35%. So the fact that it trades at a discount relative to the industry, despite the fact that it grows faster and is more profitable, really leads me to believe that this is kind of where you can unlock quite a bit of value here to the upside from a fundamental perspective, while the timing perspective also looks pretty attractive, where we're just sitting above that support line that I've drawn on the chart, and we're looking for that continuation higher here above that specific level. I'll leave you with Alphabet here as well, another one that we like, and then I'll leave you with one last bearish position here. Alphabet. Alphabet um, after breaking out here above the all-time highs here, just around 190. So far, we're just hovering near uh, that all-time high level that we broke out from a few weeks ago. So far, still holding that. Alphabet trading at only 20 times forward earnings, so also very inexpensive. Its net margins are not as strong as Meta or Nvidia. At 20, 25%, roughly 27%. So it does trade at a lower valuation, but the fact that the industry median's about 27 times forward earnings, but Alphabet trades at 20 times forward earnings really reflects kind of how deep the discount is currently trading at, given some of the challenges that we've seen here for just overall tech and Alphabet as well. And then lastly, what I'll do is I'll leave you with one last idea, and that's Apple. For those of you that joined me on these sessions here over the last few weeks, you've heard me talk about kind of my views here for Apple. Out of the tech companies, it is by far the one that I think is most overvalued, sitting at about 32, 33 times forward earnings, so very rich valuation. But then more importantly, if you look at the growth metrics, we're talking about, 10, 11, 10, 11, 12% EPS and revenue growth. That's the lowest we've seen here from Apple in over a decade. So clearly sales are starting to slow down here for Apple, yet it trades at one of the richest valuations it's traded at historically. If you want to think about value in artificial intelligence, value in things like the Vision Pro and augmented reality. Unfortunately, that's really where I think Apple is really far behind. The Apple Intelligence on the iPhone 16, not quite what I think a lot of investors, a lot of traders or consumers are hoping for. They're relying on third-party services such as ChatGPT in order to provide those services, which means that they're never going to be at the forefront of this specific industry. They're always going to be kind of a bit behind. This is definitely something that concerns me here for the future outlook here for Apple, given the fact that iPhone 16s have not sold particularly well. And then more importantly, if you look at kind of their next big product, Vision Pro, it hasn't sold particularly well. Developers have stopped developing against it. Returns have started to come in, and this is really, something that I think is starting to hurt Apple both as a brand, but also just as their future outlook is starting to look a lot more uncertain. And the fact that it trades at such a rich valuation reflects some of the downside risks that I start to see here for Apple. So I think, I've seen this changing of the guards here within the technology space where Apple, which has always been the dominator in this particular space, is starting to potentially pull back here. And you look at Meta, Alphabet, Nvidia, those are ones that I think are far safer bets given the valuation that they're currently trading at, despite kind of the short-term volatility that we've seen here from equities. So with that, that covers what I wanted to share with you here today. Hopefully that gives you a fairly comprehensive view here of what our views are here for equities and how that has changed here over the last week or so, and then more importantly, showing you some of the ideas that you can trade off of for this specific week. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.